Hey everybody, hope you're all doing well. In this video, we're talking about long-term care annuities and how they can be an efficient tool when funding your long-term care plans. So if you're someone that's considering self-insuring yourself for long-term care because you don't want to pay monthly premiums to these plans, or maybe you can't qualify for one medically, long-term care annuities may be another option for you. So the way long-term care annuities work is you put a one-time lump sum into them and they're going to instantly give you long-term care coverage. So, for example, you have $100,000 set aside that you're thinking I could use to self insure myself. If you took that and put in a long term care annuity, they'll give you an instant line to use for long term care that could be something like $250,000 from day one. That way, you don't have to have that money sitting there and hoping that the markets work out, having it grow, having to worry about what tax changes might be, what inflation is going to be. So, the long term care annuity is just a kind of a quick and easy way to get the coverage in place. Now, there are still some medical requirements, but it's a lot less stringent than getting the traditional long-term care insurance. So let's flip over to my camera here, and I'll show you guys a couple of quotes or how it works a little more closely. So the way this works is the client, he's a male age 60, has $100,000. He decides to put it in this long-term care annuity. So he puts in $100,000 up front, and they give him a balance of $250,000 from day one. This way, you get the instant long-term care coverage that you need without having to invest in the market and hoping it all works out. Now, this $250,000 gets paid out over 60 months or 5 years. So the way this works is they pay out $4,000 per month or $50,000 a year for 2 years. So that is his initial deposit. So he's spending his $100,000 down first. Now, in the event that doesn't last long enough, they're going to give him the continuation of 36 months. So that's where the other $150,000 comes into play. And so they give him another $4,000 a month for an additional 3 years. That's how you get your 5 years. So for a $100,000 deposit, you get $4,000 monthly coverage for 5 years. Now, as shown here, you can kind of see a layout of how it all works. Now, the $100,000 goes in, and it does grow slightly, but you can see not very much at all. At any time you said, hey, I want to cash this thing out, depending on when you cash it out, you may get some money back or all of it. It really depends on how long you hold the annuity to. But instantly from day one, you're going to get that long-term care coverage. And as you can see, as the cash value slowly grows in this policy, so does the long-term care coverage. So it does slowly go up. Now, this is just one example showing no inflation benefits on it. So now if we flip over to my screen here, this is an example of the same exact thing, but this person is going to purchase an inflation protection on his policy. So same person, male, age 60, $100,000. This time they only give him 173. Because he wanted the inflation, they're going to give you a smaller initial line. But this line is going to grow much quicker than the one we just looked at. So same thing, 100,000 goes in, and they'll pay out to a max of 173 day one. So this policy here pays out $2,800 per month. Again, that's for 2 years, and then it goes over to continuation or for 36 months. So basically $2,800 a month for 5 years. Now let's scroll on to this sample here. You can see that it's 100,000 goes in. The cash value, a lot less in this one. Again, because of that inflation protection. Same thing with the cash surrender value. But if you're putting money for long-term care needs, chances are you really don't care much how it grows or what the cash value is. You're just looking for peace of mind, knowing that if you need long-term care, you're going to have some protection here. So let's look at this total long-term care balance. So you can see it's at 173 initial, and with 5% inflation in the next 5 years, that goes to 195. Then it goes to 230, 275, and so on and so forth. So you can see in just 20 years, this person turned $100,000 into $332,000. Now these are guaranteed numbers, as you can see here, guaranteed. So I don't know any other investment out there that's going to guarantee that your money triples in just 20 years or potentially doubling your money in just 10 years. So these tools can be real powerful if you have the cash and means to do so. And it's usually a better alternative to have this kind of insurance than fully self-insuring yourself and taking on all that risk yourself. Okay, so I hope that helped you guys out. And now you guys have a better understanding of what a long-term care annuity is and how it works and how it can benefit you. If you want more information on different long-term care strategies, check out these videos over here. Otherwise, I'll see you guys next week. And remember that your future depends on what you do today.